Hello, clients and friends of MBP Sterling Partners. It's Jamie here in audio format today with a Q2 recap and an outlook for the second half of 2024. So let's jump right into it. Won't spend too much time about what's happened this year. It's mostly been good. We've had some up markets both in Canada and the US. The US has continued its outperformance run that has lasted many years. We'll get into that a little bit later. And then on the bond side, we saw some rates rising over the course of the year, which offset the coupons that the bonds are paying. So we came in with some more or less flat performance on the bond side up until the end of June. It's been a pretty smooth ride this year for equities. With the exception of April, where we saw a small pullback of about 5%, we've seen generally higher markets. This chart shows us the largest drawdown in any given year, and you can see it's pretty normal for us to get 10% drawdowns, and this is even amidst grander bull markets, which we're in at the moment. So we are getting tactically cautious that we might see one of these 10% drawdowns in the back half of 2024. That doesn't mean we'll get out of the market. It just means that our expectations for nice, smooth returns going forward are lesser than they were before, and history suggests that the odds are in favor of seeing one of these drawdowns. Refreshing a theme that we've been looking at for several quarters now is the outperformance of the mega caps, or the growth versus value, or the cap weight versus equal weight. This is all the same trade. It's been interesting to watch this absolutely amazing run of these mega cap growth companies. Lately, you can see the long-term chart here on the right going all the way back to the 90s as growth has just absolutely trounced value in terms of total return. So how much of an amazing run? Well, in 2024, you can see the returns of the 10 biggest companies in the S&P 500 and their contribution to the S&P's 15% return year to date. Have a look at NVIDIA here, which is this huge performance contributor of almost a third of the total performance of the index year to date. And of course, these other names round out. That doesn't mean that the rest of the 493 or 490 stocks that remain in the S&P 500 did nothing. There's lots of them that were up and many of them that were down, but the dominance of these names is pretty remarkable, and we can see that with the return of the cap weighted index just trouncing that of the equal weighted index by over 10% year to date. This phenomenon hasn't been experienced in Canada. So in Canada, we've got a more balanced market, but this mega cap rally really has continued and taken off in 2024. Having a look at the rate side of the market, bonds have been sort of wishy-washy. We saw some rates rising earlier this year, and then they've stopped out and ground around. It's led for, as we noted earlier, flat performance in the bond markets. But what we note here is the growing gap between Canadian and US bond yields. So those red and blue lines represent 5 and 10-year Canada and US bonds. And you can see Canada continues to outperform on the bond side, meaning lower yields and higher prices. That's not necessarily a good thing. That will generally lead to weakness in the Canadian dollar. So between the yield differentials, Canada to US, and the price of commodities, in particular crude oil and natural gas, normally we get good indications of what the Canadian dollar is going to do based on those. The dollar hasn't been as weak as we would have expected given these growing differentials and also very weak natural gas prices, which you can see in the bottom chart here, and really wishy-washy crude oil prices that haven't been giving us a signal one way or the other. And yet the loonie remains relatively flat. So we ask, will metals come to the rescue? Industrial and precious metals are both also mined and exported out of Canada, so those are generally positive for the loonie when those markets pick up. But our concern is that this is not priced in, even though this information is well and available to everyone. We wonder why there hasn't been further weakness in the loonie. And if not, what are we missing? Is there a positive catalyst that we should be looking for that we're missing that is keeping the loonie strong and might even be a catalyst for it to go higher? Or the inverse of that is to see the US dollar go lower. Rate expectations, as we said, not just the bond yields have been diverging, but now the expectations for the Bank of Canada versus the Fed funds overnight rate We're looking at the December implied rates here, and you can see that Canada continues to be muted, even though we're expecting cuts out of the US, two cuts out of the Fed by the end of the year. We're expecting at least two more out of Canada. And remember, we've already had one. So Canada is well ahead of the US in the rate cutting cycle here. And we would expect that to continue. The economic indicators in Canada are weaker than those in the US. So we expect that Canada will be ahead of the US in this cycle of rate cutting. Having a look at valuations, we take a simple price earnings ratio approach to this. And just as we've seen the massive outperformance in the US versus the rest of the world, we've also seen much higher multiples on earnings. So the S&P 500 is trading at almost 23 times earnings, where Canada and the developed world outside of the US are trading at about 16 times earnings, which is much closer to in line with their historical averages. So what's interesting here is to see the general upslope of the US earnings multiples over those of the global. Is this something that is sustainable? Is it a new normal? Is there some advantage of American companies over their counterparts in the rest of the world that deserves a permanently higher earnings multiple for their stocks? We're not quite sure, but that's something that we're considering, that maybe America is just a better place to do business globally. That might be the law of gravity taking place, or will we see some sort of mean reversion that we've seen in the past where the balance of outperformance has actually bounced back and forth between the rest of the world and the US? And you can see on this chart going back to the mid 80s that it has passed back and forth in the past, but right after the GFC recession of 2008 and early 09, America took over and has never looked back. So the outperformance of US stocks over that time is somewhat unprecedented, and we have to ask ourselves, is this a new normal, or will this series mean revert after a very long period of outperformance? It's worth asking, where do returns come from? So when we look at equity market returns, generally we will add up earnings growth, dividends, and multiple expansion or contraction to get to any given return on any given equity over a period of time. As you can see from this chart, dividends are pretty steady. Companies may add or subtract from their dividends, but generally speaking, the indexes pay a pretty steady dividend over time. You can see that small blue line is always positive. Whereas earnings can grow and contract, and they can be very additive to the returns of the markets in certain years. You can see 2017 and 2021 here are obvious examples of that. But the real powerful driver of equity markets and their gains and losses are whether those earnings multiples are expanding or contracting. So in years where they contract, meaning price earnings ratios go down, has an inordinate effect on the prices of equities and ultimately their returns for that year. So after having a year and a half of multiple expansion following the 2021 and 22 contraction, we're starting to wonder, is this going to be a mean reverting series, and should we be starting to get a little bit more cautious about our equity holdings? Jury's still out on that one. This can last a lot longer, and this is also somewhat at odds with what we view as regular bear and bull market cycles, where normally we'd see 3 to 5 years of a bull market cycle, and we're really only about a year and a half past the 2022 bear market cycle. Well, what about the economy? Employment conditions are starting to ease. So we're seeing US job openings continue to contract. The unemployment rate in the US and Canada appears to have bottomed out late in 2023 and has been slowly rising. When employment conditions go from amazing to just good, this is what it looks like. This is certainly not ringing an alarm bell. Unemployment rate remains very low in both Canada and the US historically. So this is not ringing an emergency bell, only to say that the direction has changed here. And now the direction is for weaker employment numbers as opposed to stronger ones. And directions matter in financial markets just as much as absolute levels do. So at the moment, we're at absolute levels that still look good, but a direction that has started to weaken. On the inflation front, we're seeing inflation start to ease and bottom out, but it's bottoming out at a level that is higher than what we were used to in the early noughts and teens. So inflation running about 3% in both Canada and the US, according to CPI statistics. These are relatively higher levels, which we've been predicting all along that inflation would bottom out and we'd start to see an environment where we're not quite used to having inflation in the 2 to 3% range instead of the 1 to 2% range like we'd gotten used to for so many years in the past. So that's given the Fed and the Bank of Canada some confidence that rate cuts are clearly on the path and the way to go. And so the markets have priced in modest cuts in the Bank of Canada and the Fed's outlook, and also the ECB over in Europe, where they have also started to cut. Those implied rates for the coming year are still for a couple of cuts, as we discussed. Nothing crazy. We would note that previous rate cutting cycles generally come fast and furious in response to some sort of economic accident or the onset of a recession. There have been one or two cycles looking back that have just simply eased like this into a Goldilocks type of scenario where hiking rates has done their job and they're able to ease them just slightly into a more normal environment. But more often than not, rates get cut in a hurry in response to some event. We don't know if that's going to happen. We don't really see that on the horizon, but of course, you never do. That's part of what causes those recessions. Is it's an unknown unknown. GDP in the US and Canada has also stabilized, so we're past the COVID craziness of extremely negative and then extremely positive recovery. We still point out, as we talked about last quarter, government spending is still extremely elevated. That's a big input to GDP. It's hard to have a recession when your governments are spending so much money and having such huge deficit spending. So it's important to differentiate between where the GDP is coming from. But at a high level, we would note that Canada and the US both have GDPs that are settling in here on the positive side and are not a cause of concern for drastic cutting or any other type of panic from the central banks. US recession probability has eased off to about 30%. And so that is a combination of indicators that can be melded together to give a indication of whether a recession is on the horizon or not. And right now it is at bay. So it appears like this soft landing scenario is starting to play out. But looking forward, while that soft landing scenario remains in the cards, we look at what might be potential positive and negative catalysts to that outlook. On the positive side, we haven't seen a whole lot of stimulus out of China. So monetary or fiscal stimulus from China, where they've had a really big property bubble burst. They are having a hard time. It has not been met with central bank reaction out of China like many would expect. So that could be on the horizon. There's earnings growth that is expected to be pretty good from analysts. If it comes in better than expected, that of course could lead to a new cycle of higher equity prices as those earnings beat expectations. And of course, increases in productivity. We've been talking about artificial intelligence a lot. There is a report out recently from Goldman Sachs that is questioning the amount of investment in AI. So it's in the trillions, by the way, how much has been invested in AI and how much output there's been as a result of that investment and it being underwhelming. But what if that productivity boom really comes? What if many companies are able to take advantage of it? Could that be a big positive catalyst going forward? On the negative side, we already mentioned valuations. Stocks do look expensive in the US, so I won't belabor that. Services inflation, it's still remaining high, even though goods have actually started to contract in their prices and certainly aren't inflating anymore. The services side of the equation remains high and stubborn. And if it does, it could forego any rate cuts. I'm sure the Fed is watching that quite closely. If employment weakness starts to accelerate, that would obviously be a negative. And of course, politically, there's been a lot of talk about tariffs recently. And so tariffs can have a chilling effect on global trade, which ultimately can have a slowing effect on economies. So we're watching out for that as potential negative catalysts. anything could happen, but these are some of the things that are at the top of our radar. So that's it for our outlook. We'd like to talk a little bit about our services. Speaking of artificial intelligence, we are starting to experiment with AI in supporting our client meetings, using transcription services and the ability to create summaries and follow-ups using artificial intelligence on those transcripts from our meetings. So don't be surprised if we talk to you about it in a Teams meeting where we're able to take that transcription. If you're up for it, we're happy to share those results with you. It's a pretty cool tool that we're experimenting with. Just as an aside, this is an image that was generated using AI. That's not a real picture. It was generated using a text-to-image AI generator. So it's interesting what you can do with this stuff, and we're starting to experiment to see how we can work it into our service offerings. That's it for today. Thanks for being with me. We look forward to talking to you all soon. If there's anything that we can be of assistance with, please remember, give us a call anytime. Take care.